Kagiso Asset Management was founded in 2001 and is headquartered in Cape Town, South Africa. Their funds are targeted at Muslim investors looking for Sharia-compliant portfolios who are able to withstand short-term market fluctuations in pursuit of maximum total returns over the long term. Abdul Davids, portfolio manager at Kagiso Asset Management, joins us from our Cape Town studios to chat about their balanced equity and equity funds. Thank you very much for your time. Abdul, let's just focus on the Kagiso Islamic Equity Fund. Can you just take us through briefly the rationale behind the construction?
Thank you very much. If you look at the Kagiso Islamic Equity Fund, as you said, the objective is obviously to maximize capital growth. And we aim the fund at investors Sharia compliant or people that are looking for Sharia compliant products. They don't necessarily have to be Muslim investors. And the objective, as I said, is to maximize capital growth over a 3 to 5 year period.
From a performance perspective, how are you doing right now? Can you give us a little color on that front?
Right now, I think we are probably not performing as well as we would like. I think if you look at the fund position, we are underweight industrials and overweight resources, bearing in mind that the fund, being a Sharia-compliant fund, can't really invest in financial shares. So the only two sectors available for the fund are the industrials and resources sectors. And right now, our view on industrials are that they are fairly expensive. So we were overweight initially industrials in the run-up and in the early days of the fund. We have taken profit in a lot of those industrial counters, probably too early. And we have a great exposure now to the resources counters at this stage.
Abdul, earlier on tonight's show, we spoke to Alvin van der Merwe from Sanlam, and I was asking him about how much value he saw in the domestic market, and he was saying that that's very difficult to ascertain at this stage. Obviously, the resource shares offer value. I think everybody would agree on that, but the rest of the market perhaps a little bit more confused. You've said you've taken profit within the industrial space. Is there any value left in the broader industrial sector? And by that I mean including retailers.
At this stage, we don't see much value. In fact, we would probably advocate selling 90% of the retail counters. I think the only retail counter that we probably would have in our normal non-Sharia compliant portfolios is a stock like Pick n Pay, which is, as many people would know, underperformed massively compared to a ShopRite. So in the retail space, we don't see any value besides Pick n Pay. I think, and again, segmenting the retail space between food and what we would like to call defensive retailers like ShopRites, your Woolworths, etc. They are all fairly expensive at this stage. In terms of the credit retailers, I think they have all run fairly hard on the back of significant space growth. We've seen significant credit being extended as well. So credit retailers, we believe, is quite expensive at current levels. And then you mentioned the broader industrials. I think in the broader industrial space, again, one can almost segment the market between domestic focused industrial counters, and they've had a fantastic time of it over the last couple of years. If you look at some of the local shares like the Barlows, in terms of the cyclical industrial stocks, they've all rallied quite strongly post the global financial crisis. Some of the global industrials, like an MTN, we believe is still offering significant value. It's one of our big holdings in the fund. But in the broader sort of industrial space, the domestic focused industrials are probably expensive.
Can we pause on MTN for a moment?
Yes.
With all the negative news flow surrounding MTN, how does that work in terms of the Sharia compliance? Is there any question mark over MTN, or do you ignore that?
No, we don't ignore it. In fact, we had our Sharia board meeting last week, and it was one of the topics that we discussed at the Sharia board. From an ethical point of view, bearing in mind that the fund, being a Sharia fund, also encompasses some of the ethical considerations as well as part of Sharia compliancy. We obviously take, and the Sharia board takes a dim view of unfair practices, bribery, corruption, all of that type of things. And typically what we would do as the managers of the fund, we would engage with the company management quite aggressively in those cases. In the past, we've engaged with Sasol, for example, another big holding of the fund, in terms of its fines. We've engaged with Tiger Brands in the past in terms of the bread price fixing story. In the case of MTN, I think what we have at this stage, and all we can go on is what is in the public domain, is a deposition won by what we could arguably call a disgruntled employee. And all of the statements that have been made in the public is really from that deposition. At this stage, we know the facts are fairly limited in terms of the public domain, But those facts indicate that the former employee, he paid the monies out of his own account. At this stage, no monies went from MTN side. I think from what is in the public domain, there's very little to find fault with in terms of the company management at this stage. Bearing in mind that the former CEO, Futuman Shteko, is no longer with the company. Some of the key individuals are no longer with the company that have been finger-pointed. So it's very difficult at this stage. So even if MTN was in the wrong, it's more a case of individuals being wrong rather than the company having had bad practices.
Abdul, can we just come back to your exposure to the resource sector? You've obviously increased that weight quite substantially, and I've seen in the portfolios we've got in front of us that you've got a fairly large exposure to Sasol, but you don't seem to have much exposure to BHP Billiton. Can you just chat about those two relative to one another?
Okay, in the case of Sasol, what we have seen is that the oil price rallied quite strongly. It has come down, and in our assessment, we typically look at the key drivers for a company like Sasol. In our assessment, the fair value, if I can call it that, of the oil price is probably between $80 and $85. So it still has some way to fall. So when it went to over 100 to close to $120, that was really cream on the top for Sasol. Even though it didn't participate, as the oil price went higher, the share price didn't follow suit. What we believe from a Sasol point of view is that given its exposure and given its mix of businesses, it is actually more geared to a weaker rand than to the higher oil price. And it's almost twice geared towards a weaker rand compared to the oil price. So even with the much weaker oil prices, with the rand having weakened sharply over the last couple of months, Sasol's earnings should remain fairly resilient. So for this year, we're looking at probably close to 52 rand of earnings. That will probably come down to around 40 to 45 rand of earnings next year. If you look at the share price at about 350 rand, you're looking at very attractive PE valuations. They have switched to a progressive dividend policy, so your dividend yield on a 12-month basis is in excess of 5% at this stage. The balance sheet is quite strong, and obviously the cash generation would be fairly intact, even though it would grow at a negative rate over the next 12 months. In contrast, Billiton, we know that they've got about 40% exposure to oil, and that is also a growth portfolio for them. The concern that we have is that iron ore prices, even though it has started to come down, are still significantly above our estimate of what a normalized iron ore price should be. Bearing in mind, for decades, the iron ore price traded at about $35, and for the last couple of years, it went over $170, $190. It has pulled back to about $139, but even at $139, we think there's still significant scope for it to fall further. Now, Billiton has started, and they've addressed the market concerns around the capital expenditure program. They have said that they will curtail capex in areas where, if the market doesn't justify, they'll cut back on that capex. But from a pure valuation point of view, we just think that Billiton is probably fair value at current levels compared to Sasol, which is fairly attractive.